Splitting a business to avoid VAT may look clever, but it often isn't. HMRC can join entities together where links exist and challenge the arrangement. Consider contracts, commercial reality, and long-term costs before acting. Many owners toy with splitting their business to avoid VAT because it appears to shave off costs with minimal effort, but the surface savings can mask deeper legal and operational risks that are easy to underestimate. The instinct is understandable. When the VAT threshold looms and margins are thin, avoiding a charge feels like protecting value. Yet HMRC rules are designed to look through structures that exist mainly to sidestep tax, and the regulator's lens focuses on how the deal actually works, not just how it is described on paper. The calculation often overlooks the power HMRC holds to treat closely connected entities as a single VAT registration when economic, financial, and organizational links align. The word "and" matters here. They need to evidence all three, but when they can, they may mandate a single registration going forward, eroding any short-term gain. That means duplicated admin, reissued invoices, strained client relationships, and possibly penalties or interest, none of which show up in the spreadsheet that justified the split. The smarter approach is to anchor any structure in commercial reality first, and tax consequences second. Not the other way around. If two entities genuinely negotiate separately, carry separate risk, invoice independently, and manage complaints and extras in their own right, that aligns with reality and documentation, which is where accounting best practice lives. If, however, the split is cosmetic, while one party controls price, service, and cash flow, the substance will trump the labels, and HMRC will likely press for a combined position. The line between efficient planning and artificial fragmentation is drawn by contracts, conduct, and cash. Contracts should mirror how the parties behave: who sets the price, who handles complaints, who gets paid, and who carries liability. If the paperwork says one thing, but day-to-day processes say another, the weak link becomes a lever for challenge, and small business tax savings can evaporate quickly when reconciled against compliance costs and reputational damage. The commercial upside of keeping activities focused is real, but it must be defensible under scrutiny. Marketing claims should reflect the legal reality, because language that implies bundled services when the model is actually split can invite questions that are tedious to answer. Clear invoicing, direct payment flows, and authentic separation of responsibilities build credibility, whereas vague promises and free add-ons invite the kind of probing that few want when the VAT threshold is in sight. A measured plan for VAT registration, paired with pricing that reflects market value and tax, often outperforms thin margin contortions. It is easier to scale without awkward re-engineering later, which is the operational dividend people forget. The practical test is simple and unforgiving. If the structure disappeared tomorrow, would the businesses still stand alone? With separate strategy, finance, and operations, or would everything fold back into one de facto entity? If it is the latter, the supposed savings from splitting a business to avoid VAT may be illusory, and the eventual cost of correction could exceed the original outlay by a wide margin. The safest course is deliberate design, grounded in genuine commercial logic, transparent contracts, and consistent execution. Supported by solid tax and legal advice that anticipates HMRC's perspective. When the model is authentic, it always stands up. If anything I've written in my blog post resonates with you and you'd like to discover more of my thoughts about business splitting to save VAT, then do feel free to call me on 0743 42 87 603 and let's see how I can help you.